With Bitcoin trading just below all-time highs, this begs the question, what is the best indicator to predict the next Bitcoin trend? Well, we've taken a look at a lot of data, analyzed a lot of correlations. We're going to show you what we discovered and what that indicator is now telling us. To do so, we have to talk about Bitcoin. What is its purpose? To preserve buying power against inflation. How does Bitcoin work against inflation? Well, it has a decentralized nature. It's not controlled by any government or financial institution. More importantly, it has a limited supply. There's a fixed maximum limit of Bitcoin that can be produced, and it cannot be printed like fiat currency, such as the US dollar. What is the number one cause of inflation? M2. M2 is a measure of money supply. It includes cash, checking deposits, easily convertible instruments called near money. As M2 increases, for example, as a result of Federal Reserve policy, interest rates, etc., Bitcoin tends to benefit. We can see here in blue, that's M2, that's the money supply. In red, that's Bitcoin. This goes back to 2015. And what we can see over time is that as M2 increases, the amount of cash or near money increases in the economy, so does Bitcoin. There's a lag between the two. Notice how the blue line moved up before Bitcoin. We're going to show you in just a moment what that data reveals. But from a conceptual point of view, there's a limited amount of Bitcoin. There is potentially an unlimited amount of US dollars. So as the Federal Reserve prints more money, for example, as more money is injected into the economy, there's more dollars competing for all the services and goods. So those goods and services become more expensive, as does Bitcoin. That's how Bitcoin works against inflation. But let's take a look at one of the most remarkable opportunities. We call this a 2020 head fake. Well, in blue, that's M2 on a year-over-year basis. In red, Bitcoin on a year-over-year basis. Now, early 2020, we know the stock market had a very rapid sell-off as a result of the COVID crisis. Stocks went down, a lot of different assets went down, including Bitcoin on a risk-off type of move, meaning traders were just selling everything. However, during that period of time, the Federal Reserve drastically cut interest rates and also injected a tremendous amount of capital into the economy. Well, we know how Bitcoin works. As M2 increases, so does Bitcoin. So that first initial sell-off actually gave us a tremendous opportunity as Bitcoin, from a fundamental point of view, based on that injection of money into the economy, based on a massive, very quick reduction in interest rates, fundamentally, Bitcoin looked very, very good. Is there a lag between M2 and Bitcoin? Absolutely. We took a look at the data going back to 2016 through present date, and this is what we discovered. We tried to establish a correlation between Bitcoin on a year-over-year basis against M2. And then we tried offsetting it, meaning offsetting that we pushed it back 1 month. We said, okay, how does Bitcoin today compare to M2 a month ago? Meaning January to February, so to speak, on a year-over-year basis. We tried to find the correlation, and this is what we've discovered. The highest correlation exists with an 8-month lag, an 83.9% correlation. What does this all mean? In simple terms, that when M2 tends to move to the upside or downside, by the way, in either direction, usually speaking, the most predictable move occurs in Bitcoin about 8 months later. It takes time for all that cash. The Federal Reserve cuts interest rates. They have a new, sort of policy that injects more capital into the economy. It's not immediate. It takes time for that money to flow through the economy to end up in assets like Bitcoin. So if we see a big move in M2, there's no reason to move quickly. There's, historically speaking, actually around an 8-month lag. Bitcoin tends to follow M2 by about 8 months. Now, what affects M2, the money supply? We've mentioned the Federal Reserve. We've talked about different Fed policies. Number one, interest rates. As the Federal Reserve lowers interest rates, it makes it easier to borrow money. It frees up money. Think about this. less money that's used on interest rates for car loans and mortgages, things of that nature. There's more disposable money in the economy. That increases M2. Conversely, when the Federal Reserve raises interest rates to slow down the economy, they're sucking capital out of the economy. That reduces M2. We can also talk about programs like quantitative easing. The Fed purchases financial assets to stimulate the economy. This tends to increase M2. We're going to show you in just a moment actually how effective QE is on Bitcoin. And also, we talk about Fed policy. There's other things they can do, adjusting reserve requirements or engaging in open market operations. That can also affect the money supply. But very simply, just think about the total amount of dollars out there in the economy. Whatever the Federal Reserve does, let's just ask ourselves, is there more or less money out there, disposable cash floating around the economy that potentially could be used to buy some Bitcoin? Also, there's economic events, recessions, economic booms, changes in consumer behavior. That can also affect the M2. Think of a recession, things tighten up. People tend to spend a little bit less as opposed to an economic boom, new stock market highs. People feel very generous, and that can certainly affect M2 as well. Now, generally speaking, we know when interest rates go down, M2 increases. As rates come down, it becomes less expensive to take out loans to finance. There's more money floating out there in the economy. Here's a picture in red, the federal funds as they were reduced from 2001 to 2002. In blue, that is a rapid increase in M2, but we have better data for you. Here we can see there's obviously an inverse correlation that exists, but this is really the most important part. In blue, these are the Fed funds. Now, these are the changes that occurred from January through December of every year. And in red, that is the change during the same period of time every calendar year of M2. In particular, notice those years we saw a massive reduction in interest rates. 2001, for example, notice that red line spiked higher. That's the increase in M2. We also know that occurred in 2007, 2008, the financial crisis. Interest rates were severely reduced, M2 increased. We also had, shortly after that, quantitative easing. Now, interest rates were near zero in 2011, 2012. The Federal Reserve couldn't cut any more, but they did enact QE, quantitative easing, and that also stimulated M2. They injected more money into the economy in a different form. Now, we had the COVID crisis, of course. We had a massive reduction in interest rates very quickly, in addition to an injection of capital into the economy, a massive spike in M2. And then we talk about 2024. The Federal Reserve has already cut interest rates once. They're expected over the next, let's say, 6 months or so to cut rates potentially by another full percentage point. Well, if history is any guide, if the Federal Reserve cuts rates by another 1%, a full percentage point in the next 6 to 12 months, what do we think that is going to do to M2? If it follows history, M2 should increase. Vote on our Bitcoin poll, by the way. Based on all this, what is your prediction for Bitcoin in 2025? Will it crash below 50,000? Will it remain more or less where it's been lately between the 50 to 75,000 level? Will it break out to new all-time highs, 75 to 150? Or are we really optimistic? Do we think it's going to be more than 150,000? And keep in mind the historical tendencies and what the Fed funds futures tell us, where we think interest rates, and also think of the overall economy, the job situation and everything else. Think of how aggressive the Federal Reserve may have to be in the next 6 to 12 months or so. We hope this has been helpful. We look forward to seeing you back soon.